What if I told you there's a way to avoid paying taxes? Legal too. Would you believe me? You'd be right to be skeptical, because there is a big, giant pile of nuance on that no taxes part. It's called a health savings account, or HSA, and that's what we'll cover right now. My name is Christian Bell, and here we talk about all things personal finance. In this video, we'll talk about what health savings accounts are, their advantages and disadvantages, and my favorite technique for maximizing an HSA's triple tax advantage, which, spoiler alert, means paying no taxes. So a health savings account is a tax-exempt savings account to help you pay for certain medical expenses. Isn't it nice when the name of the thing actually makes sense for what it does? Anyway, they were first available in 2004, and there are about 34 million HSAs currently. This is according to research from Devenir. So what are the advantages of HSAs? The biggest advantage of HSAs is arguably that triple tax advantage. First, contributions you make to an HSA are not taxed. Second, there's no tax on the growth of that money. Third, when you take money out of an HSA, if you use it for a qualified medical expense, that distribution is tax-free. Even if you can no longer contribute to your HSA, distributions for qualified medical expenses are still tax-free. However, you do have to be careful because certain states tax HSAs, so make sure to consult with a tax pro. Another major benefit is that your employer can also contribute to your HSA, and those employer contributions are not included in your taxable income. Now, you don't have to have an HSA through your employer. Self-employed people can have these too. Your employer or health insurer will have an HSA administrator that they recommend, but you don't have to use that one. Definitely shop around for other providers. Some big names include Health Equity, the HSA Authority, Lively, Fidelity, Further, and HSA Bank. Although if you have an HSA through your work, you can set up automatic payroll deductions, which is what I do myself. And you generally have until the tax filing deadline to make contributions for a given year. Another advantage is that money in an HSA rolls over from year to year, so you don't have to spend all of your HSA contributions every year. This is different from a flexible spending arrangement, which is often compared to an HSA. A huge advantage to HSAs is that you can invest the money, typically in stocks, bonds, mutual funds, or ETFs. Not all HSA administrators support this, and sometimes there's a minimum threshold, commonly around $2,000. So HSAs sound great. And they are, but that doesn't mean they have zero disadvantages. One big disadvantage is that there are strict rules that determine who is allowed to contribute to an HSA. There are several, but perhaps the biggest one is that you have to be covered under what's called a high deductible health plan, or HDHP. What's that? It's a health insurance plan where the deductible is much higher than normal. The deductible is the amount you pay before insurance typically starts paying. But in exchange, your monthly premiums are fairly small. This is in contrast to traditional health insurance plans, where the deductible is somewhat smaller but the monthly premiums are much larger. The IRS sets limits on the minimum deductible and maximum out-of-pocket cost for a plan to qualify as an HDHP. Out-of-pocket expenses typically include things like deductibles, co-payments, co-insurance, but importantly do not include premiums. Now, not every health insurance plan is an HDHP, so you'll want to look for phrases like HSA eligible. Another disadvantage is that there are annual contribution limits, which are different depending on if you have single or family coverage in your HDHP. There are catch-up contributions if you're 55 or older that raise these limits by $1,000, and these limits are in total. That's including any employer contributions. The limits can get a little complicated if you become eligible for an HSA partway through the year. And if you don't want to deal with the complexity, I totally get that. I made that same choice myself. I signed up for an HSA, but it lined up with the new year, so my contribution limits are very straightforward. You do want to be careful not to go over these contribution limits because there's a 6% tax on excess contributions, although in general you can withdraw the excess contributions before the due date of your tax return to avoid this penalty. A big disadvantage is if you withdraw HSA money for something other than a qualified medical expense, you'll have to pay income taxes on the amount that you withdraw. There's also a 20% penalty tax that applies if you're under age 65 when you make this withdrawal. Another disadvantage is that for a qualified medical expense to be paid with HSA money tax-free, the expense has to happen after the HSA is already open. This is another reason to open an HSA really as early as is practical. So what's a qualified medical expense? The IRS publishes guidance on this, and some examples include acupuncture, bandages, certain dental treatments like teeth cleaning, prescribed medicines and drugs, and chiropractic services. In general, insurance premiums are not considered qualified medical expenses, but there are exceptions. HSA administrators will also have somewhat easier to search lists. For example, this is the list that HSA Store maintains. Another disadvantage of HSAs is that there are reporting and record-keeping requirements. Essentially, you have to be able to show that you're using the HSA for its intended purpose, which, again, is to help you pay for qualified medical expenses. So the IRS wants to know all about your contributions and distributions, all that stuff. Also, that you're not trying to cheat on your taxes, like getting reimbursed for the same expense twice. So yeah, don't do that. And definitely keep your receipts. Worth consulting with a tax pro to make sure you get it right. So, should you have an HSA? Well, the answer to that is highly personal and depends on your situation. Remember that to have an HSA, you need an HDHP, and that means you're paying for more of your health insurance costs out of pocket through a higher deductible, rather than through traditional higher premiums. As an example, if you don't have the money to cover that whole larger deductible when you need to, you might have been better off with a traditional health insurance plan, at least for that year. In general, HDHPs are great for healthy people with no ongoing healthcare costs. Now, my favorite way to use HSAs is as an additional tax-advantaged account, essentially another IRA. As long as you're in a situation where you don't need to use your HSA money right now, and that part is really important, you can invest the HSA money today and maximize the advantage of those triple tax benefits when you do use it later. Contributions are tax-free, growth is tax-free, and distributions for qualified medical expenses are tax-free. According to Fidelity, an average retired couple will need $315,000 in after-tax money to cover healthcare costs during retirement. But don't let that number scare you. Thankfully, there are lots of HSA calculators online to help with the numbers here, like this one from HSA Bank and this one from Benefit Wallet. Remember that compound interest can help enormously here, especially if it has several decades to do its thing. Now, if you're going with this approach, you want to think of HSA contributions in the same way that you think of other retirement account contributions. It's money for later. Now, if you need to use the HSA money for a qualified medical expense today, absolutely do that. That's the whole point. In fact, you can take this whole HSAs as an investment idea way too far. Definitely do not avoid or delaying getting the health care you need simply because you're trying to maximize the amount of time your HSA money has to compound. So that's all for this video on HSAs. I hope it was helpful. Let me know in the comments. Make sure to like and subscribe and share it with a friend who needs to see it, all that stuff. Have a wonderful day, and I will see you next time. Bye!